everyone, this is Kishore Puruswani. Welcome to the third video in the series of Basics of Investments. On popular request and feedback, we have decided to upload the videos on YouTube so that you can watch it at your convenience in the comfort of your homes whenever you like. And please do like, share and subscribe to the YouTube channel if you like the same. Today's topic is investment in IPOs safe? A small recap. In the module 1, we discussed why and where to invest. In why to invest, we discussed about the financial goals, we discussed about the parallel income, and we also discussed that one of the reasons could be that you wanted to park your surplus funds and beat the inflation. And among the various options available, we considered gold, PPF, fixed deposits, real estate, stocks, and also tried to conclude that stocks is an option which delivers high returns, have high liquidity and low risk. In the module 2, we covered how to invest in stocks. Basically, we discussed in this module about the primary market, about the secondary market. We touched on the secondary market. We compared the difference between primary and secondary markets. We did a few analysis of the IPOs, and we also deliberated on the learnings from the primary market. And finally, we concluded with basic requirements of investment in primary or a secondary market. So today we will be discussing whether investment in IPOs is safe. So continuing from the previous discussions and the previous analysis, let us again look at some analysis. Over 2018 to 20, say March or February, there was practically a bull run. A number of companies approached the primary market and got a good response from the investors also. And we have selected a few companies to analyze the scenario, how it went, what was the response, and finally where it landed. Let us see ICICI Securities, a known brand, a known name, and one of the trusted brokerage firms. It came out with an issue which was listed on 4th of April 2018. The issue was priced at 520 rupees and the size was 4,000 crores plus. Now we have compared the recommendations of some of the premier investment groups, the capital market, the stalwart in the stock markets since almost more than 4 decades. It gave a good rating, subscribe, 45 out of 100. Chittorgarh, courtesy Rudra shares, they also recommended subscribe. And Smart VRC, which I am representing today, also gave a recommendation of apply. We'll see in the next few slides how these ultimately fared. Ispanna Spurti, issue at 856. Recommendations of capital market, Chittorgarh was subscribe, whereas Smart VRC was conservative with an average rating. Sterling and Wilson, it came out with an issue price of 780 rupees with an issue size of 3,000 crores plus. There was no concrete recommendation from capital market with a rating of below average 40 by 100, whereas Chittorgarh gave a recommendation of subscribe for the long term. Smart VRC was categorical in saying can be avoided. Yes, it can be avoided. IRCTC, again known brand, at 320 rupees, issue size was 645 crores. All the three, capital market, Chittorgarh, Smart VRC, were bullish. They said they gave good recommendations. SBI Card, issue price at 755 and issue size of 10,000 crores plus. The best trading amongst all by the capital market, 58 by 100. Subscribed by Chittorgarh. Short to medium attractive by Smart VRC, but there was a caution in the long term with respect to the valuations. Now let us see the performance of these companies. ICICI Securities, where all the three stalwarts recommended to apply, and this was the fate. Right from the day of listing to practically the current date, except for a few days in the month of July and August, the script has never seen even the issue price. The issue price was 520 and it went as low as below 200. Yes, below 200. If you see here, when there was a crash in the market, and it also got listed at 400 plus, and it is hovering around 480 rupees or something in today's market. We'll discuss what do we learn from all these analysis. Now Spanna Spurti. While capital market and Chittorgarh both were bullish, both gave subscribed recommendations, Smart VRC gave a caution with an average rating, got listed around the issue price, went up as high as 1400 rupees, high on one particular day, and closed at 1390 or something, or 86 in November 19. And since then it has seen the downtrend, and almost now it is trading at 600 rupees against an issue price of 856 rupees. Coming to the third company, Sterling and Wilson. Except for Chittorgarh, capital market was also a bit skeptical on this Sterling and Wilson. Smart VRC gave a clear-cut recommendation that it should be avoided. And we see the fate. It got listed below the issue price, maybe around 740 or something. Issue price was 780. It touched a low of around 94, 95 rupees. And it is hovering around 200 plus. So in more than 1/3 loss from the issue price of 780 rupees. Now let us look at we saw this graph in the previous module also. It has been a star performer of all the IPOs in the past 2 to 3 years. Issue price was only 320 rupees and it has always been above the issue price, gone up as high as almost 2000 rupees and is hovering around 1380 or something. And then again, there is a talk of further OFS in this IRCTC. So almost, if you are lucky, you could have gained more than 6 times on, even if we sell today, it is almost 4 times returns. Here, all the three, capital market, Chittorgarh and Smart VRC were bullish, and all of them gave good recommendations, as we have seen. Now, performance of SBI Cards. We discussed in the last module also. All were bullish. Capital market, Chittorgarh and Smart VRC. But it got listed below the issue price of 755 rupees. And the reason was probably the market. Market was in a bear phase. It had crashed and it went further low to 496 or something. And now, since mid-August, it has come back in green and is today trading at around 820, 830 rupees with a good recommendation for major brokerage houses even today to buy the scrip. So a good scrip remains good if we are patient. And the very learning, if we see the words of the genius Warren Buffett, the stock market is devised for transferring money from the impatient to the patient. If we just see the graph of IRCTC again, or SBI Cards, if one was impatient, sold at listing, or got panicky at 497, 496, then the investors who bought at this price, held the shares patiently, have been handsomely rewarded. So the rule number one in the market is don't lose money. And the rule two is don't forget the rule number one. That means we have to be very, very cautious in selecting the companies, whether in the primary market or in the secondary market. Then only we can make some money from the market. So the learnings are: invest selectively. Yes. Read prospectives and opinions of various experts. Just look at the example of these 5 companies only. Could you conclude something? Not emphatically. So you have to do your own research. You have to do your own research practically and see which are the brokerage firms or the analysts whose recommendation has proved right. Go into the detail, read the prospectus, and then take a opinion whether to invest or to stay away. And as a retail investor, we should always choose to bid at the cutoff price, not anywhere between the low and the cutoff price. Most of us, or most of you might be aware that SEBI has changed the allotment rules. Now, whether you apply for 1 lot or you apply for say 12 to 14 lots, today the lot size is such fixed that it is around 15,000 rupees. So at the most we can invest as a retail investor 2 lakh rupees, so 12 to 14 applications. So either you apply 14 lots or entire 2 lakh, or just 1 lot in 1 application, the chances of allotment are same. So if you have number of demat accounts in your name, in your children's name, in your family's name, it is always advisable to apply multiple applications if you are convinced that a company is good, rather than applying lump sum for number of lots in a single application. Since there is no trading history, the company has come out in the market for the first time, will be listed. Hence, predicting the stock movements is very, very difficult. We have to be vigilant and take informed decisions. So why do we lose in IPOs? Primarily because valuations may be high. The promoters or the investors will try to get the maximum price. And if they are able to convince the investment bankers, the valuations may be high, and at the other end, the losers will be the investors. Poor fundamentals. If all of us remember the issue of Reliance Power, it came out in the market for putting up 5 power plants. with no experience or no data in the concerned field, and we know the fate. And very important is timings. No company, no company plans to come out with IPOs in a bear market, but they don't have a control. If the dates have been announced and the market crashes, they are left with no alternative. SBI Cards is an example. So the timing also plays a very important role, whether the market is an uptrend, downtrend, and the best results are when the market is stable. Again, greed of promoters. The venture capitalists or the promoters, if they are coming out with an issue, they will do so to get maximum cash from the investors. And sometimes this greed of promoters is such that it puts investor into a difficult situation. And nothing is as uncertain as market. Even the reputed brands fail. Not only in India, worldwide, even the Facebook IPO didn't get a good response. Even the Infosys IPO didn't get a good response. But we see today where these companies stand. There are n number of such examples. Discussing more on the timings, as we just shared, that promoters prefer to launch IPOs in bull markets, and all IPOs get oversubscribed, but not all of them give positive returns. Just to give you an example, 5 IPOs were launched in the insurance market in 2017, and only SDFC Life gave some decent returns. Similarly, when a sector is opening up or is in boom, many companies will come out with the new issues or follow-up issues and try to collect as much cash as possible. Example is in 1990s, the aviation sector, many new airlines came up. Names which were never heard of, NEPC, Damania Airways, Modi Luft, and all of them vanished within no time. Yes, all the investors incurred huge losses. So what do we need to watch out for safe investment? Very, very important is objectives of the IPO. What is the objective? If it is expansion, nothing better than that. You have the previous performance of the company, the future projections. You can take a well-informed decision. But if it is a new business, you have to rely on the prospectus and the reports and analysis. Similarly, again, if it is for paying off debts, that means it's a running company. Then you have good data available. You can take an informed decision. Very important is reading the prospectus and report analysis of not one houses. Choose whom you have faith in. See their past performance, how they have performed over the past few years, how their analysis have gone. Take your own decision and do read more than one. Take a decision based on the concrete analysis. And very important is the management team. Ultimately, the team which is going to steer the company, which is going to deliver the results, if it is a proven management. The recent example is Happiest Minds. Everyone knew the promoter, Mr. Suta. And so we saw the response it got from the market. And even the listing price, more than 100% appreciation. And the price is more or less stable today. Very important is risk-taking capacity. Of course, if you put in one application and you put in only 15,000 rupees, at the most you may lose 30%, 40%, 50%, maybe not a big loss. But say suppose you were to apply in SBI Cards, where everyone got a confirmed allotment of one lot, and you had put in 5, 6 applications, 755 rupees, the issue price, and you held it for some time, got panicky below 500. Just imagine the losses if there were multiple applications. So you have to judge your risk-taking capacity and then apply accordingly. Whether you can absorb the risk and come back in market, or if it is not so, then you have to invest slowly, gradually, make some money, then take risks. Now, of course, there are no cases of lockup periods. Earlier, there was some lockup periods where you had to invest for a particular time, particular period where you cannot sell the shares after listing. So you have to be, if an issue comes up with lockup period, you have to be very, very cautious. These are some of the do's and don'ts where we need to be careful. We are in the learning phase. And as you approach the market, as you invest in the market, as you put your money in the market, none else other than you will be able to analyze what to do, how to do, when to do. Thank you very much for a patient listening, patient hearing, and I look forward to your feedback, your suggestion, so that we can come out with videos where you wish to learn and invest fruitfully in the market. Looking forward to your suggestions and feedback. Thank you very much.